Give it up for Danielle DiMartino.
Danielle DiMartino.
Danielle DiMartino Booth.
We have a special guest today. First, give us a preview.
We do. We have Danielle DiMartino Booth. I'm sure everybody knows her. She needs no introduction, but she is CEO and Chief Strategist of QI Research. She is also a former Federal Reserve insider. She wrote a book called Fed Up, which I'm sure many of you have read. And so looking forward to talking to her this morning.
Awesome. Well, let's get her in here. Good morning. How are you?
Good morning. I'm great. How are you? You're getting me at the most tenuous time since the government shutdown. We're about to have all kinds of data hit in 5 minutes.
Yeah, we are, and while you're on, we'll talk about it because we'll see the data hitting the tape in real time, which is going to be exciting. But right away, I got to ask you, the Fed minutes came out yesterday. Any surprises there? What's the temperature of these folks going into possibly a transition Fed in a few months?
So I think that the timing could not have been better or worse worse for the Trump administration, better for Fed hawks who do not want to lower rates again on December the 10th. It wasn't the minutes. The minutes were really exactly what we expected. There were many participants who felt that we didn't need to lower rates again for the rest of the year. Several thought that we should be lowering them. Several thought we shouldn't have lowered them at all. In other words, there was a non-voter who agreed with Jeffrey Schmid, who dissented against a rate cut at all on October the 29th. So, but the fact that the administration, somebody decided to cancel the October jobs report. Not only that, much more importantly, push off until 6 days after the Fed meets the release of the November non-farm payroll. So even though we have an overabundance of data, right? We've had almost 500,000 negative job revisions just in the data that has been reported up until what we're about to see. The highest first half of negative job revisions in real time. I'm not talking about benchmark revisions that come 18 months later and all that BS, but that's the highest number of negative revisions since 1979. So the Fed has, we just had job cut announcements hit a 15-year high. Jay Powell, when he was at the Carlyle Group from 1997 to 2005, he founded the industrials group there. He speaks to all of these CEOs who are pushing through with mass layoffs. He knows exactly what's happening on the ground. But again, the hawks at the Fed are looking for cover. They're looking for an excuse to say they can't see through the fog. And bizarrely enough, ironically enough, the administration that wants for the Fed to cut rates just gave them an excuse not to, because they're not going to have any relevant data, non-farm payrolls for October rolled into November until December the 16th, 6 days after the Fed meets. Never seen an administration shoot itself in the foot like this.
So, Shai, hang on one sec, Shai. I just want one quick follow-up question there, because I've been saying this for a long time. The Fed has a whole bunch of economists. They know the answer, but they have to kind of react to the public information, right? So which makes maybe for bad policy. I don't know. What do you think about that?
Well, it makes for very bad policy. Look, we've had just the shutdown gave the Fed an opportunity to embrace more alternative data sets. Heck, ADP handed them one on a silver platter. And now we've got rolling 4-week numbers for the entire private sector. Yeah. And so, this was the Fed's opportunity to say, you know what, we're going to come into this century. We're not going to rely on the data that 89% of economists surveyed by Reuters said that they did not hold faith in a few months before the shutdown occurred. So this is a squandered opportunity for a very political Fed that wants to do everything that it can, like him, love him or not, to stick it to the administration to the point that they're derelict in their duties to the American people, because there's an overabundance of data. Forget what's about to happen with September. That's as moldy and oldie and stale as you can get. What's happened subsequent to that? We know that Americans are losing their job. We see these mass layoff announcements. UPS 48,000, Amazon 14,000. That was followed up by Verizon and 15,000. These are not small numbers. And the Fed knows that it needs to be easing policy. I think this next December 10th meeting, you are going to see fireworks of dissents, probably on both sides, if they cut. If they don't cut at all, you will probably see more dissents in one meeting than we've seen in decades.
Yeah.
right.
Shai, we're going to have numbers in a second here, Shai.
Yep, we have the data right now. So change in private payrolls was plus 97,000, survey plus 65,000. Jobless claims came in at 220,000, survey 227,000. Continuing claims higher at 1.974 million. Expectation was 1.950.
And yet we added to those negative revisions. So we got a negative 33,000 on the prior 2 months in July and August.
Of course.
Of course.
And the S&P futures are like sleeping.
And
they're not moving.
And the most importantly, and this is what's going to make life really difficult for Jay Powell, because a few meetings ago, he shifted our focus to the U3, to the official unemployment rate, saying, all the revisions in the past, maybe non-farm payrolls aren't the best official indicator for us to follow. And here we have it, a 4.4% unemployment rate that is just a tenth shy of their year-end target. They're within spitting distance of what their year-end target is on the one indicator that Jay Powell said was the most important.
Yeah.
It is fascinating. And I think we're at a cycle high on continuing claims to boot. And by the way, those continuing claims, this is for the survey week for the November non-farm payroll. Any week that contains the 12th of any month is considered to be the survey date. Earlier this week at 3:14 a.m., the Department of Labor accidentally released the survey week for October the 8th, which contained October the 12th, October the 18th. In 52 hours time, we've gotten the October survey week for non-farm payrolls and the November survey week for non-farm payrolls.
So, markets are barely reacting to this. Obviously, it is old data. It doesn't include Doge cuts. It doesn't include layoffs. What is the expectation kind of going forward, or what do you feel this does or doesn't do to the decision in December?
Well, I would say the only thing that, as I was saying before, you're going to get a lot of dissents from the Doves. The Doves were very polite. Waller and Bowman did not dissent at the September meeting. They held a unified front. Even though they would have wanted a 50 basis point rate cut, they were not going to show any allegiance to Stephen Miron, who, as far as the rest of the governors are concerned, needs to make his way right back to the White House where he came from, where he put his paycheck on hold for 4 whole months. That is not exactly showing reverence for the institution of the Federal Reserve after having been sworn in as a governor. So that's why they had that unified front with a 4.4% unemployment rate. There will be dissent on December the 10th if there's not a 25 basis point cut. Philip Jefferson, the vice chair of the Fed, has come out and said the labor market is problematic. Susan Collins, a voter, she's come out and said the labor market is problematic. And we know we've got Bowman and Miron and Waller. So you're talking about a 5-way dissent right now, simply because that unemployment rate printed at 4.4%.
Yeah, I mean, having a spy in the house of love is not really a good thing when it's revealed like it is. But let's shift gears a little bit to consumer credit, because I know you've been writing about this a lot, with used cars, not used cars, just general consumer credit. How problematic is that right now?
Well, we had 2 interesting companies report yesterday. S&P, most importantly, reported on autos specifically and said that it is seeing respectively subprime delinquencies for cars and prime delinquencies for auto loans at the highest since 2009 and 2010, respectively. So I love it when everybody on the Twitter sphere is like, it's contained to subprime. I'm like, what are you all, a bunch of Ben Bernanke's? Because it's not. It's not contained to subprime. We're seeing it move up the prime ladder in reaction to millions of Americans not being able to service their student debt that they never thought that they would have to service. And the other report that came out from TransUnion yesterday showed that credit card, personal loan, every single form of credit besides auto loans, serious delinquencies just flatlined. That's where we saw credit availability, underwriting standards pull back the quickest was in the auto loan space, but it's just hovering up at a really high level. But what we heard yesterday from TransUnion is that all of the distress and the delinquency is not improving and that it's moving up into into the prime ladder with an unemployment rate at 4.4%. That's the kicker. We're at the heights of the Great Recession, and we haven't even seen what's to come in terms of the increase in the unemployment rate. That's what you have to marry to the distress in the consumer sector. That if we're going, as we see these mass layoffs begin to roll through, remember mass layoffs, most companies like Verizon, UPS, Amazon, they're going to give their employees 6 to 9 months of severance. But that severance pay is going to end. And the WARN notices we're seeing come from individual states. Those are smaller. They only get 6 to 9 weeks of severance. So we are going to start to see on a rolling basis, a continued rise in prime consumer delinquencies.
Yeah.
And, everybody is talking, or well, at least in the X sphere, how the K-shaped economy, it's fine because we have the upper part of the K holding up the entire economy, essentially. But is this fine? Is this, how do we marry this with, market being at all-time highs and half of the economy is not doing well at all?
Well, I think that narrative holds together today. And when I say today, I mean today. If the NVIDIA earnings are enough to reverse the risk off trading that we've seen, if we see Bitcoin close, say, above 93,000 today, that could help things. We could see some consolidation and a rally, and therefore that narrative hold. But I can guarantee you the wealthy have taken notice of what's been happening in the markets, the increased volatility, the degradation in the real economy. There's a lot of nervousness in this market. If we get the passive flows that come jumping on in at the end of November and much bigger with quarterly rebalance at the end of December, that's great. But at the same time, the Federal Reserve is telling us that liquidity is drying up in the system. We've got blue owls of the world saying, oops, we're canceling the merger of 2 private credit funds. The cockroaches that Jamie Dimon mentioned continue to come out of the woodwork and put pressure on credits. S&P reported just a few days ago that bankruptcies are running at a 15-year high. This story has not ended. We can have the momentum trade pick up today, and we can see that going forward. But the horse is kind of out of the barn when it comes to, a year ago, the AI trade was being supported by cash flow and earnings. Now, when you look at the debt to earnings ratios of any given Mag 7, we see that their debt to equity ratios have gone up tremendously. Yeah. And we're now supporting this AI narrative, which supports the 10% of consumers, top 10% of earners who account for 50% of consumption. We're seeing that tested. And this has got to be making Jay Powell nervous, especially because his standing repo facility does not appear to be doing the job that he wanted it to do. And it looks like the market's going to be clamoring for not QE 2.0 pretty soon here going into the end of the year.
Yeah, I mean, I've been in the SOFR rate is, it's been surprisingly volatile. SOFR's so many small institutions and even individuals will borrow SOFR plus at a bank or somewhere like that. And it's such an important part of growth for that smaller part of the investment community that with that uncertainty and with that kind of stickiness where SOFR is right now, what, is there, when could we expect some relief? I mean, it's, if the Fed doesn't cut a lot, then if that SOFR is going to be sticky.
It certainly is. And you're certainly right. And again, Bank of America came out with a report a few days ago that said that the average small business is now losing money. I mean, Small Business America, the largest employer in the country, they're on their knees. Credit is prohibitively expensive for them, and they're being forced to lay off themselves. That's what we're seeing in the ADP monthly data. That the large companies are just now starting to catch up and lay people off in earnest. But the Fed is not making monetary policy for the broad economy. The Fed is making monetary policy to spite Donald Trump, and that's not their job.
That makes sense. And we're also seeing, a lot of these AI companies were issuing debt because they're running out of spending and we're not seeing an ROI on this spending. And we have some talk of some investor groups kind of starting to shy away from these bonds, and some actually even having sold out of the position entirely. So, what does this look like if this situation, gets worse for the sector and for those bonds and for those companies?
Look, the narrative has to hold. And now we've got this canary in the coal mine called Oracle. And we're watching the credit default swaps on Oracle like a hawk. We're looking at all of the big names in the private world, KKR, Carlyle Group, Blackstone. We're following them very closely because they're the ones that have a cockroach problem. And we're seeing it increasingly. And the problem that we have right now, Tricolor and First Brands have nothing to do with AI, but the way they were financed, when you hear overnight in the Twitter sphere, I think you even shared it in the chat room, in the QI chat room, Tracy, when you're talking about OpenAI, NVIDIA and factoring. So if they're starting to play cute with their balance sheet in order to pump up revenues by factoring receivables, that's exactly what First Brands did. So to your point, Tracy, as the market begins to question more how these AI firms are justifying committing to trillions of dollars in investment, even though they're only barely profitable, if not losing money on some of these ventures.
Yeah, and when does the retail investor get whacked because they're jumping on the bandwagon?
That's a very good question. And I don't want Bitcoin because I think it's a viable exchange. We're not transacting in Bitcoin. Let's get real. It's got a 99% correlation with the NASDAQ 100. But I think that Bitcoin is the thing to watch in terms of the risk appetite of the retail investor, as well as the direction of the broad market. It is your ultimate barometer on whether or not the AI narrative is holding or breaking. And it's the ultimate barometer because so many people are Michael Saylor acolytes and want to be, they want to be faithful to their, take me to your leader. They would drink the Kool-Aid, a lot of them, even if it was Jim Jones serving it. So Bitcoin is kind of, to me at least, it's the linchpin to gauge what's going to happen with the retail investor and what's going to happen with the broader market and the AI narrative.
Yeah, that's a good point. Shai, we got a little over a minute left. Any last minute thoughts for Danielle?
Yeah, what are you specifically looking at? We talked about Bitcoin, we talked about delinquencies and such, but what else are you focused on for kind of clues on where this economy is and where it may be going?
So, I'm also watching the housing market very, very, very closely, seeing the turn in construction employment. when it was the lone holdout, and it held out for longer than any major sector, right? Because we had all of the Biden infrastructure spending, and that continued to work its way through. Data center construction, of course, continues in earnest. But one of the feathers that we put out earlier this week demonstrated that out of AI, non-residential private construction is contracting. So I am watching the housing market. I'm watching commercial real estate. We have found a way to get into a CMBS structure and actually have the AAA tranche take a loss on the distressed side. So watch housing, watch commercial real estate, and watch those banks.
Wow. Well, Danielle, it's so nice to meet you. Thank you so much for spending time with us this morning.
Thank
Excellent
you.
interview. Great intel for sure. Look forward to talking to you again.
Absolutely. Thank you for having me.
Thank you.
Shai, we have great guests on the show, but we were just talking to the GOAT.
Oh, yeah, for sure. She is
Unbelievable.
absolutely amazing.
Fantastic.